Good afternoon. I'm Patrick Armstrong, Chief Investment Officer at Plurimi Wealth, and it's the 21st of October 2022. So I've been asked to give a 4.5-minute video on what's happened in markets this year and what our outlook is for the coming months and quarters. So ambitious because a lot has happened, but it's been a pretty terrible year for markets. Whether you're an equity investor or a bond investor, you've probably lost capital values if you've been a long-only investor anyway. Global economic growth is slowing. There's political chaos, particularly in this country. There's war in Europe, and inflation has really forced central banks' hands, that they've had to tighten interest rates. They've turned what was quantitative easing into quantitative tightening from the US Federal Reserve, which meant the Fed's gone from purchasing bonds to selling bonds into the open market. So Treasury returns are negative 20%, gilt returns are minus 30% year to date, equity returns by the MSCI World are 23% negative year to date. If you put that in sterling terms, it's minus 7.5%. So strong dollar has really been a headwind for returns in dollar terms. If you're measuring your returns in sterling, it's been much easier if you are a global investor investing outside of the UK. So traditional balanced approaches have suffered this year. And it's a function of the Fed withdrawing liquidity. As they've started selling treasuries and inflation has gone up, the Fed's hiked interest rates as well. Treasury yields have gone from 1.5% at the beginning of the year to 4.2% today. And real yields have also risen. So it's not just that treasury yields are higher. The yield versus expected inflation over the coming decade have moved from minus 1% at the beginning of the year to plus 1.67% today, which is creating a headwind for all assets. There is an alternative to taking risk right now. You can park your money in cash and treasuries and get a reasonable nominal return and probably cover the costs of real returns with inflation just by buying a treasury right now. So capital has flown out of other assets. Liquidity is less abundant. Speculation's not as prevalent as it was last year, and all assets have really suffered from this. And I think it's the Federal Reserve and global central banks tightening monetary conditions leading to this. And you can see on this slide, equity returns are down 20% this year. It's all come from multiples. Multiples are lower now. Multiple contraction has been the driver of the sell-off in equities. Earnings per share estimates have been very resilient throughout this year. So for the MSCI World, analysts expect the MSCI World to deliver earnings per share the same as they did on January 1st this year. In the United Kingdom, the FTSE 100, analysts actually expect the FTSE 100 to generate 30% more earnings per share than they did at the start of the year. So the market's down, measured by the FTSE 100, about 8%. But the companies within it are making 30% more than people expected coming into the year. So the contraction in equity multiples has led to lower equity prices, even though the earnings have been quite resilient. And I do think that's creating some opportunities potentially. And the bad thing about owning equities is you've lost 25% this year if you've bought the index, but generally that's led to pretty attractive purchase prices. If you're buying equities after a big sell-off, returns in the future have generally been higher. This chart here shows returns over 1, 3, 5, and 10 years for the S&P 500 after it's fallen 25%. So past performance doesn't tell you anything about future performance, but one thing that is definitely true, equities are cheaper than they were at the beginning of the year. The earnings outlook probably has deteriorated a little bit more than analysts are implying with their forecasts. But better entry points are available now for equities and for bonds than they were at the beginning of the year. Our outlook for this year is that equities and bonds probably will give you returns right now. They're priced to deliver positive returns. Equities are trading at 14, 15 times earnings, which is a pretty normal PE multiple. At the beginning of the year, it was 20 to 22 times. So that multiple contraction I talked about has made equities cheaper. I like to own equities that have dollar revenues. I like to own equities that have defendable profit margins. I'm attracted to luxury companies that are selling to high-end consumers. I'm avoiding low-end consumers, which are having their purchasing powers really basically impacted by higher energy prices, petrol prices, mortgage costs. Luxury consumers aren't suffering from that. In bonds, I like to own short duration corporate bonds. In the United Kingdom, you can get 6 or 7% for a 2-year bond from a triple B, an investment grade company. So although it's been a pretty terrible year for traditional investors, we've positioned our portfolios quite well by being short duration, by betting against companies that don't have a path towards profitability. I think that's still the best way to position portfolios going forward. Taking some risk, but not taking excessive risk, I think is the best strategy for the coming year. Hope that's of use. 5 minutes, I went an extra 30 seconds over time, but I hope that's of use for the Circle Square Forum. Thank you.